Hello world, welcome to Farm the Market. One of the crucial components of trading and investing is being able to measure properly your strategy's strengths and weaknesses, and make a serious analysis of what is working and what is not working. Keeping a detailed journal is imperative. You must keep track of all the variables that go into your decision-making process. Some variables might be more subjective, like a certain formation in technical analysis, for example. But regardless of the type of variable, you must try to simplify as much as possible what went into your decision-making process and log it into your journal, so that you can periodically look back and analyze the data. That's the only way you can expect to improve over time. I thought it would be interesting to share some of my traits with you. The purpose of this series will not be to explain a given strategy in depth, or to claim that I have the unique and epic strategy that beats the market every time. To be honest, I just hope it's a good exercise for me, where I get to analyze some of my traits deeply by explaining them to you rather than just logging numbers and notes in my blotter. After all, you know what they say. If you want to understand something well, try to explain it simply. And hopefully for you, by looking step by step at examples of real traits, you might find interesting some of the techniques or adjustments I use on my trades. And this might help you in your journey to develop your own trading skills. Let's get started. On November 2021, Ford started to form what looked to me like a bull flag with a nice lateral consolidation pattern. With a range defined, I was looking for a breakout with nice volume to go long Ford. On December 10, the breakout materialized. However, before buying, I determined two very important things: my target price and my stop loss for the trade. Technical analysis is always subjective, but for me, I determined that the most relevant prior breakout for Ford was at 1354. So, I decided to take the difference between the upper edge of the latest trading range, 2053, and 1354, and use that as a decent estimate for the possible move higher. Using round numbers, the difference was about $7. So, I decided to set my target price at $27.50. For the stop loss, I decided to place it below the lower edge of the recent range and give it a little breathing room. So I decided to use 1880. Stop losses are not perfect. They don't protect against gaps, but it's imperative to always start with some level of protection. With those two levels defined, I calculated the possible return versus risk, and decided the ratio was acceptable, 2.3. Not a great ratio, I usually prefer 3 or higher, but the setup looked very attractive to me. Also, Ford has been a very popular stock for call buyers recently, so I thought that was an extra tailwind for the trade. Once that was settled, I proceeded to buy 200 shares of Ford, almost at the market close. I like to trade as close to the end of the session as possible to guarantee the daily close is where I want it to be, avoiding intraday false breakouts. 6 days go by, and the stock is not behaving as I expected. Usually, this pattern should work quickly. On December 20, the intraday action took the price right to the lower edge of the range. Thankfully, the margin I gave the stop loss avoided the position to be closed there. On January 3, the price finally breaks out of the range with good volume. The trade starts to work. On January 11, the stock is forming another nice-looking lateral range, with volume decreasing. The trade is looking good. I decided to move up my stop loss just below the upper edge of the latest gap. In retrospect, I should have moved my stop loss sooner, following each gap up. That was a basic mistake on my part. Thankfully, the market didn't punish me that time. Anyway, with my new stop loss, ignoring for a moment the possibility of a gap down, The trade is now in a win-win situation. I can calmly wait for the stock to keep going up towards my target, or if the market moves against me, just let my stop loss do its job and lock in a profit. I like to compare this scenario with having the lead in a football game. You can now start to set the terms of the game according to your play style and objectives. On January 13, during the market session, the stock breaks out of the recent range and gets close to 26. At this point, the position is more than 2/3 in profit territory versus the target price. So I decide to sell half of the position and lock in a profit. The technical structure still looks good, but I like to sell into strength and scale out of my positions. Besides, if the technical structure improves and another potential entry setup appears, I can always add more back into the position. Also, this pop gives me a nice opportunity to protect my profits more efficiently. As I mentioned before, although stop losses are important, using options to protect a position is much more efficient in my opinion. So, whenever it makes sense, I replace my stop loss with a long put option. Given where the spot was, I could get a nice premium selling a call very close to my target price, and with the premium received, I could buy a put with a strike right at the lower edge of the recent range, and have some cash left over. In this case, I decided to do just that. I sold the 27 call. My position is now a covered call since I'm long 100 shares, and I bought the 23 put, both with expiration date January 21. Once these options positions are open, I cancel my stop loss. There's no need for it anymore. Going back to the football analogy, now the game is pretty much secured. I can take my starters off the field and just let the clock run out. At this point, the trade is as mechanical as it gets. It will take care of itself until January 21, when the options expire. If I don't do anything in the meantime, my scenarios on January 21 will be 1. Ford closes above 27. My short call is exercised and I sell 100 shares at 27. The put expires worthless. The trade is over. 2. Ford closes below 23. My long put is exercised and I sell 100 shares at 23. The call expires worthless. The trade is over. Or 3. Ford closes between 23 and 27. The trade is still open and it's time to reassess the situation. On January 14, the stock technical structure keeps looking good and my short call loses 1/3 of its value. I decide to close it. By doing this, I remove my profit ceiling, and the money I generated with the calls covers the cost of the put and there's a little cash left. Now I can say I have a put hedging my position for free, without sacrificing any potential upside. On January 19, the stock has a nasty drop. Although the put has me covered, the technical structure I liked is gone. At this point, there is no reason for me to remain in the trade, so I decide to close the trade completely, selling the remaining shares and selling to close the put. I could have given the trade a couple of days, but I rather just have room available in my portfolio for a better trade with a nice setup should it come by in the next 2 days. After all is said and done, start to finish, Ford moved 4.76% up, and my trade had a 13.60% return. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.